or opportunity zones, and then they won't exist anymore?
Yes, I mean I think the program ends in 2026, which is why that we have that 7-year period. So there won't be any new ones. You can't make any new investments after that.
Oh, okay.
But it's funny rule. The regulations the IRS came out with said like you could hold it like until something like 2042 or something.
Well, that's why I was confused, because I heard that date and I heard 2026, and I was a little bit confused in why there were two different times.
Yeah, that 2026 is when the program ends, meaning you can't do any new ones after that. Mm-hmm. Unless, of course, the legislature in its benevolence sometime between now and then extends the program, which seems very likely. But putting that aside, but they tell you that nevertheless you will continue to get the tax benefit through, and I think it is 2042. And don't ask me why they chose that date.
Yeah, maybe that's
but it's a long time from now.
Exactly.
I think that's probably the next time. That's going to be the next time the Jets win a Super Bowl. Maybe
that could be, yeah. Or maybe the date Tom Brady retires.
Yeah, right. Yeah, one of those two, right? Yeah, so it's not like you were talking before about answering that question. It's not like after 2026. You're invested in an opportunity zone fund, and the fund has to dissolve. The fund will keep going.
Correct. Right? Absolutely.
Yeah, okay. That's
so when you
point.
set up the entity of the fund, then that has a time limit of existence as well. It's not in perpetuity. It's just up until maybe 2026 or 2042, whichever one. Then the entire fund disappears. Is that correct?
Well, it's certainly, yeah. I mean, yes. I will tell you, I have not written that 2042 date into any of my documents because I'm afraid people would laugh at me. But I think most investors expect that the project would, whatever they invest in 2019 is going to be liquidated well before 2042.
Right.
Yes. Yeah.
All right, does the fund have to own the real property that it's investing into or the project that it's working on, or can multiple funds invest in something that somebody else owns?
No, you can the latter. So a fund has a choice of investments. It can invest in qualified stock, qualified partnership interest, qualified property, qualified businesses. So you could have a partnership down at the bottom, if you will, and it owns the project, and you could have 100 qualified opportunity zone funds, each owning an interest in that partnership, and that would all be permitted.
Okay.
Okay. And then what about, we're looking at this from the investor level right now. Let's talk about the actual fund owner now. Is the fund, whoever creates the fund, they have to create it in the form of a corporation, I believe. And are these funds considered securities by the SEC or by law?
Well, let me correct you there. It has to be a corporation or a partnership. So those are the two choices. And then, just as a further clarification, in the Internal Revenue Code, the term partnership is defined as anything taxed as a partnership. So it doesn't have a state law meaning in the Internal Revenue Code. And all that means in practical terms is that limited liability companies, which are taxed as partnerships, are treated as partnerships for these purposes. So it has to be a corporation or anything taxed as a partnership, and that could include a general partnership, a limited partnership, or a limited liability company that is taxed as a partnership. And, yes, they are all going to be securities. Back last year, and this year to some extent, when blockchain tokens were being introduced and people were unsure whether those were securities, and we went through this whole Howey test and so forth. But a share of stock in a corporation and an interest in a partnership are definitely securities in the hands of passive investors.
Got it. Right. So if myself and Vicky want to start, let's say, the Ron and Vicky Opportunity Fund, slam dunk security and set up like that, right? It's got to be looked at as a security.
Yeah, I mean, yes, but now I'm just being a sort of technical, geeky lawyer. The interest in that fund would not be securities in your hands because you would be running the show, God forbid, right?
Right.
You would be running the show. In Mark Roderick's hands as a passive investor, it is a security. So you are definitely, you guys, if that's what you're up to, you definitely are going to need to qualify, under the securities laws.
Okay, now the next step at that point would be, of course, finding investors for a fund. I'm looking at this as a guy who wants to start a fund and get involved in the actual development. I'm a real estate broker. A developer. So now all of a sudden I start the company, I start the corporation, and then what? Do I go to somebody like you and say, okay, Mark, write me up a private placement memo, and I start raising money that way?
Yeah, you come to me or someone like me. Possibly better looking, and you.
That's why we do the podcast, Mark. We're in the same boat.
Yeah, that's right. A face made for radio, right?
Yes.
So you then say, okay, we want to raise money. Now, the fact that you're raising money for a qualified opportunity zone fund doesn't matter at all. It doesn't have. Qualified opportunity zone fund is a tax designation, just like a real estate investment trust or REIT. It's a tax designation, has nothing to do with securities laws. So the person like me would say, I don't care what you're raising the money for. Let's talk about the different offering opportunities available to you. Are you willing to take investors, only accredited investors? And if you are, I say, well, let's do a Rule 506C offering. And if you say, no, I really want to make this available to non-accredited investors, then I say, well, here are some other choices. In a Rule 506B offering, you can have up to 35 non-accredited investors. Or if you want to go big time, we can do a Regulation A offering for this fund, and then you can, raise up to $50 million. So the securities law aspects are decoupled from the tax designation. Do you see what I'm saying?
Yes, that's an interesting point. So now what you're saying then is that, yes, a non-accredited investor can get involved in an opportunity fund if the opportunity fund is set up in such a way that will accept that investor. So it's not just a
That is exactly right.
Very interesting. So that's another great thing about these opportunity zones, because anyone who has the capital gains can take advantage of these things, regardless of your income, et cetera, and there's going to be something available for you. And again, I'm sure you're seeing funds pop up left and right. So it gets back to your original point where you have to be careful as to what these funds are and who's involved in the development of them.
Yeah, so far, I will tell you, all the funds I've seen have been for accredited investors. And, of course, that's partly because it's just on the securities side of the ledger, securities law, it's just so much easier doing it that way. But the other side is that accredited investors have a lot more money and are more likely to have large capital gains. I mean, that's the reality of life in America today. So this is one area where you definitely think twice before going to the trouble, the cost and expense to have the structure to allow non-accredited investors, because you would ask yourself, well, how many of them are going to actually invest? How many of them have enough capital gains to make it worth their while? So now, I'm sure probably a lot of non-accredited investors listening to this show saying, that guy doesn't know what he's talking about. I have plenty of capital gains. I'd be happy to invest. So
yes. Yeah, I bet that's true.
I'm sure there are a lot of folks who do, but so far the developers have been picking the low-hanging fruit, which is accredited investors only.
Maybe we should explain the difference between accredited and non-accredited for people who don't understand that listening.
Oh, sure. Okay. So, when you ask me a question like that, I can't help giving a little historical context. So I will do that. So ever since our securities laws were created back in the 1930s, there have been a couple very fundamental points that have never changed. And one of them is the concept that wealthy people do not need the protection of the government because, they can hire fancy lawyers and accountants. So wealthy people don't need the government. Non-wealthy people do. Non-wealthy people need the hand of the government around their shoulder. And every time I say that, it sounds sort of sarcastic, condescending. It's not. The system has worked very, very well. And so that's the background, accredited versus non-accredited investors, substituting accredited investor for wealthy person and non-accredited investors for non-wealthy persons. So in 1982, the Securities and Exchange Commission came out with a definition of accredited investor that basically has not changed. And that is an accredited investor. You're wealthy. You're deemed to be a wealthy person for purposes of that fundamental concept. If you have income of at least $200,000 a year, or with your spouse you have income of at least $300,000 a year, or your net worth is at least $1 million without taking your house, your principal residence, into account. So now there are other categories of accredited investors for corporations and partnerships and banks and all different things. But for most people, that's the definition for individual human beings. And you might note, and your listeners might note, wow, things have changed since 1982. $200,000 a year was actually quite a lot of money in 1982. It's not nearly as much money today, and yet the definitions haven't changed. And really that's because the SEC it turns out that there's not nearly as much fraud out there as the SEC thought there might be. So they're finding that non-wealthy people do not need as much of a government arm around their shoulder as it was once thought. But in any case, that's the line of demarcation between accredited and non-accredited.
Oh, okay.
That's a long answer to a short question.
But now everybody listening can understand very well what we're talking about.
I think the Internet has made it a lot easier for investors, too, to get information and to understand with investments. So you could basically look up, anything that you want to know is on there. So the educational part of the Internet is the good part of the Internet, I think.
True.
Yeah, well, that's what crowdfunding is about, right?
Right.
It's the Internet.
Exactly. Yeah, exactly. And I know that you're doing a lot of work on that too. So, just a couple more points on this on these funds. Then, so now, when somebody is creating a fund and they see the opportunity and they've done everything that we talked about before with the private placement, and they raise, let's say they raised $10 million, for example, they have a time frame where they have to put this capital to use. Is that right? They have to be able to invest or at least start the process. Is that right?
Well, yes, that's a great question. It is probably the great question because no one knows the answer quite yet. So okay. When the law came out, that was one of the first questions people asked. The general idea is that the money has to be deployed. It really has to be deployed immediately. At least that's what the statute implies. And so, as you know, the